Hi, Tony. It's been an exciting 2024, and we're reaching towards the end of the year. Maybe perhaps if you can share your thoughts about how the markets performed, the bond and equity markets over the last 12 months.
Hi, Shankar. Yeah, so it's been a good year. And, I would give the bigger perspective that, last couple years were kind of more complicated. Remember, in 2022 was the bad year for stocks and bonds as interest rates went up. And then 2023 was a year where actually markets did okay, but it was sort of so choppy and volatile. I think most clients I spoke to then weren't really feeling that great about investing. But 2024, I thought, was a clearer, solid year of performance. Clients seemed interested to explore investment ideas, and I think had generally been rewarded. Equities over the course of 2024 look like they're going to end up over 20% up this year. It was led mostly by the US, but Asia has done fairly well. I'd say Asia is kind of an outperformer and kind of really came in only in the second half towards the end after sort of struggling in the first half. And then markets like yeah, the Eurozone and Japan, they were doing better in the first half, but have kind of been struggling lately as their currencies have weakened. The last thing I would add is, fixed income also, I think, hasn't been as exciting as equities, but has generally been giving sort of steady returns, especially, us being here in Asia. Our Asia like credit funds have generally been giving solid returns, generally in the neighborhood of around 5%. And the global bond funds have generally been okay too, but they did face some headwinds as some of the bond yields, like, a US 10-year bond yield, did kind of creep up over the course of a year by a little bit. But really, all around, I'd say 2024 was a very solid year, and both stock and bond investors should have been pretty happy.
In 2024, a lot of conversations that with our clients has been conversations about interest rates and inflation. What are you expecting for these two economic drivers heading into 2025?
Yeah, I think you're right. I think a key story for the success of markets in 2024 was the fact that, we've had continued economic expansion, but at the same time, it's come with inflation sort of continuing to moderate. That allowed some interest rate cuts and creates, a very sort of just nice, stable backdrop for investing. But if you look at the numbers in the last, quarter or so, you are seeing a sort of plateauing of a lot of these inflation trends in most regions. And the second phenomena I would highlight, and we've published our views here at UOB Asset Management, that we do see that we called it our higher for longer white paper. And the key concept here is just that we see a lot of the global economy as being more normal now than were in the last decade. And we're going to be operating in an inflationary and interest rate regime that's going to be higher than what we've seen in the last decade. And so, these two forces, where as we get by COVID, inflation comes down, but as we realize what's normal, I think we're starting to realize, normal is a little bit of a higher inflation and interest rate than we've seen for a while.
Given that view, Tony, what is the outlook for the bond markets next year?
I think for bond investors, I don't think we have to be counting on lots of rate cuts to be the main source of getting our returns in fixed income. What I like about bond markets and fixed income funds in general is that we're getting good steady yields, and that the peak of the inflation problem and the peak of the high interest rates are behind us. I think we're now talking about the fact that it's not going to be completely smooth sailing and downward trajectories, but we don't need that for fixed income. As long as it's not going to soar, that means the yields we get will be a steady source of returns for the coming years.
Tony, a lot of the returns this year have been driven by a lot of risky assets, especially in the equities. Do you see the momentum continuing towards 2025?
Yeah, I think the main way we would say is, don't make things too complicated. What we have this year is the fact that the global expansion continues in all the major regions. In China, we're having stabilization policies that I think kind of help reduce the risk that if there was one region, that might have been one that could have been somewhat recessionary. But with the stabilization measures there and the growth we're getting from the US, and the fact that interest rates are coming down, this creates a very healthy backdrop for investing. I think you're right to highlight there are risks, and that, volatility and growth assets like equities, can certainly still happen. I think the markets are focused on some of the risks around President Trump's policies. A lot of his policies do look like they're inflationary. But, despite that, I think the market sort of recognizes that one of the key motivations for President Trump is that he's excited to really juice the economy and get good growth. And while there's some inflation risk there, the fact is I think markets are somewhat comforted that the growth outlook looks solid.
So, Tony, closer to home, what do you think about the Asian markets, the ASEAN markets, and how do you see them performing this year, as well as how is it going to build up towards next year?
The fact is, in our base case views, we saw a lot of strengths for Asia. We like the valuations. We think the economic backdrop is stable. We think Asian currencies look quite strong. And the fact is, Asia, you can usually do well if the developed markets are cutting interest rates. So I thought there was a lot lined up. The main concern, and it has been our view too, as we're setting off for first quarter, we've downgraded Asia to more of a neutral call for the first quarter, as we are concerned about some of these tariff policies and the headwinds that they can create. But I think, in our strategy team, as we sort of lay out our views, and we sort of were agreeing that, well, we should be a little bit cautious for first quarter to see how these things play out. But our base case view is we don't necessarily think the tariffs are going to be that problematic in the end. We think it's mostly negotiating points to get some sort of trade deal, and then I think we can fall back to looking at the sort of key attractive fundamentals that we see in Asia. And our view is 2025, Asia can be an outperformer again.
So, Tony, for a modern investor, is it glass half full or glass half empty? What are the top recommendations that they should be doing in 2025?
It is our recommendation to, overweight equities. But, for a conservative investor, that doesn't mean you have to take on a lot of equities. Just whatever you might have normally taken, you can maybe take a little bit more than usual. But it also, I think for the conservative investor, a portfolio that's sort of balanced around fixed income, balanced around some commodities like gold. And I think that creates, pretty stable portfolio. And the other thing I would highlight, what I like about fixed income is that, eventually this economic expansion will slow down and it would face a downturn. And that's when your fixed income portfolio can, really sort of balance and cushion your overall portfolio. You don't have to sort of, bet big time and stick your neck out too much. And you can still get good, stable returns.
Thanks, Tony. It's been really exciting talking to you this year. It's been exciting 2024. We're really looking forward to 2025. Thank you, everybody.
Thanks, Shankar.